Back in the 80s, Luxembourg found a way to open up Europe's entire market to the investors. And suddenly it became the go-to place for the big finance. But now things are changing. Investors are suddenly pulling their money out of Luxembourg and are putting it in Ireland. So my question is, what is going on? So back in the 80s, Europe was going through a big transformation. The borders were opening up thanks to the Schengen Agreement, and the countries were getting closer, literally and economically. But while people could move now freely between the countries, money couldn't. The capital was still kind of stuck within the national borders. Now, here is why it's a problem. The best way to make capital work is to pull a whole lot of it from multiple sources, from wealthy individuals, from insurance companies, from pension funds, pull it together and invest it into some kind of a big and hopefully profitable project. For example, infrastructure, real estate, established companies, startups, whatever. All in the hopes to generate some returns, right? Now, investment funds are doing exactly that. Essentially, those are our main vehicles to turn large amounts of capital into projects, into actions, into benefits to society and, of course, shareholders. But back then, every European country had its own set of rules and regulations for these funds. It was a bureaucratic nightmare for a fund manager to raise money across borders, meaning to raise money from different countries to finance a single project. Want investors from Germany, Spain, and Italy finance one single project? Good luck. It was practically very cumbersome. Then Luxembourg had an idea. What if they could be the first country in Europe where investment funds are able to raise money across the whole continent? Think about it. As fund manager, this gives you an enormous advantage, because instead of being limited to being able to knock on the doors of the investors in your own country, you can now go ahead and knock on the doors of the investors in the neighboring countries. So what else do you need? So back in the 80s, Luxembourg has passed a set of rules and regulations that allowed investment funds based in Luxembourg to operate across borders and to raise money across borders, to raise money from multiple European countries, with just one single approval from Luxembourgish authorities. And just like that, Luxembourg became the go-to place for the big finance. Okay guys, just to avoid that it sounds like Luxembourg has tricked its way to the top through tweaking of the regulation, let me just clarify something. The opportunity to pass this set of rules was available to every single EU member state. Why? Because the concept to raise money across borders was enabled at a higher level on the European level 3 years earlier, and it was backed by a European directive. How these things work is that apparently it's not enough to have defined it on the European level. The law only applies as soon as a country in the European Union has adopted it into the national law. And that's exactly what Luxembourg did. And of course, in this sense, Luxembourg had an advantage as it's a smaller country with more flexible regulatory environment in comparison to Germany or France. But it's not dishonest. This was a true game changer for the investment fund market in Europe, as the center of gravity suddenly shifted. Many investment firms have flooded into Luxembourg, bringing with them financial advisors, accountants, financial service providers, all those corporate jobs that you can imagine, now suddenly were planted in this little country in the middle of Europe. It didn't take long for Luxembourg to become one of the biggest European financial hubs, now managing 5.3 trillion euro worth of assets, or a quarter of the whole European investment fund market. But here is a twist. Most of these funds in Luxembourg are what we call active funds, so they rely on fund managers to actively go and pick up their investments in order to maximize the returns. And the returns that the investors in those funds expect to achieve should be higher than the standard market benchmark return, which is around 8 to 10%, let's say 8%. And for their efforts, active fund managers get commission. Now, there has been a huge debate whether or not these active funds are actually worth it. The debate sparked when a very famous professor, Burton Malkiel, claimed in his best-selling book, Random Walk Down Wall Street, the following. A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. In other words, markets are so unpredictable that no matter what investor, no matter how skilled, can consistently outperform them. Implication: the active managers might be charging very big fees for the results that can be matched or even beaten by random picks. Enter John Bogle, the founder of Vanguard. He put the idea into practice and said, instead of trying to beat the market, why not just be the market? And with that, he went ahead and created the first ever index fund. This type of fund does not try to outsmart the market. It simply tracks the market by following some type of an index, like for example S&P 500, which represents 500 biggest American companies. Remember how the active funds try to outperform the market and achieve an average market return of higher than 8%? Well, the passive funds are perfectly fine with those 8% on average. And since no active management is required, the fees are kept very low. So, simple, affordable, and effective. It was a game changer. And it worked. Investors loved it. Vanguard now manages assets worth of $8.7 trillion, which is slightly more than the GDP of Germany and Japan combined. Now back to Luxembourg. Luxembourg is still the biggest financial hub in Europe, but in the recent years, something concerning has been happening. Investors are pulling the money out of Luxembourg, and Luxembourg's market share in the investment fund market is going down. Look at this chart. It shows how Luxembourg is losing ground. And who is rising? Ireland. Look at that red line going up. So, what's happening? Here is the thing. Passive funds have been growing consistently since 2014, sometimes even in double digits, meaning every year more and more investors are putting their money into those passive funds. Meanwhile, active funds have had lower growth rates and in the last 2 years even negative, meaning investors are pulling their money out. Ireland has been a big winner here, as it bet on the growing market of the passive investment funds, offering the European investors a possibility to invest into low-cost, effective, passive investment vehicles. And the bet is paying off. Since 2001, Luxembourg's market share has gone down by 1%, while Ireland's market share has increased by 1.2%. And I know 1% up or down might not sound like a lot, but consider this. The European investment fund market is 21 trillion euro. So even 1% change means billions of euros that are being redistributed. In fact, Ireland is now one of the very few countries in the EU with a budget surplus, meaning their government makes more money than it spends. And Luxembourg used to have a budget surplus too, but not anymore. So what does this all mean? Well, Luxembourg is still the biggest investment fund center in Europe. Tick. But it kind of missed the train with the passive investment opportunities, which appear to be the double-digit growing market. In the meantime, Ireland has become a very serious competitor by seizing this opportunity. As investors continue to move toward the passive investment strategies, the question is, how quickly will Luxembourg be able to adapt to this trend? And, well, the time will tell. Whatever happens, the next few years will be very interesting for the European financial landscape. So stay tuned. Bye.